Thanks for joining us. I'm sure that many of you are well aware of the benefits of true infrastructure within the construction of a portfolio, especially in difficult economic markets. Today I'm speaking with our Head of Infrastructure, Gerald Stack. Gerald, volatility continues out there. How has infrastructure performed over the course of the last few years?
Well, I guess the first thing to say is that its performance has been very much as expected, and that is that earnings have been reliable. And that when I say that, I mean earnings and performance of true infrastructure assets. Infrastructure really divides into two major segments, utilities, regulated utilities, and transport infrastructure. Regulated utilities provide an essential service, it's regulated, and as a result you should expect earnings to be reliable over time. And we've certainly seen that in both the very recent past in the last year and really over the last 3 to 5 years. In the case of transport infrastructure, again, you're providing an essential service, you're providing the ability to get about within a city, you're providing the ability to get to and from an airport. So an essential service, you've got people using more and more aviation over time, using more and more traffic over time, so very reliable performance, and we've seen that again in the most recent past, but also over the longer term. So very reliable performance, very reliable earnings, notwithstanding that there's a lot of volatility in the broader investment market. That's not to say that infrastructure hasn't as a whole had its problems. There have been problems, but where those problems have been experienced is where those assets aren't what we would consider to be true infrastructure. So they're assets that find their revenues and their earnings influenced by both commodity prices, competition, or even sovereign risk. So they're assets where those earnings don't have the same degree of reliability over time, and from time to time the volatility issues that we've seen thrown up can affect those sorts of assets.
Has infrastructure actually delivered on the return expectations?
Very much so. You know, as we've already touched on, the infrastructure universe divides into two components, regulated utilities and transport infrastructure. In the case of regulated utilities, as the chart on the screen shows, for US utilities, the return on equity over the last 5 years has been remarkably stable. That's not to say that in a downturn the returns don't decline, but as the chart shows there, the decline is almost imperceptible. The second chart that we've got there shows the return on capital employed for European utilities, and you see a very similar picture, very stable over a 5-year period. And we would expect that. That's the nature of the regulation process. Utilities have a compact with their communities. They undertake to provide a reliable service of the utility, whether that's water or energy, and in return they get a fair return from that community, and that's the way that regulation works. So in those situations where you have an economic downturn, as the world has been going through, utilities are able to continue to earn that stable return through time, and the two charts show that very clearly. Now, one of the things I would note here is that for the European utilities we show return on capital employed, whereas for the US utilities we show return on equity. The reason we do that is that's the nature of the regulation in those jurisdictions. In the US, the regulator allows you a set return on equity. In Europe, typically that regulation is structured to allow you a set return on total capital employed on the debt and equity. Now, as I move to a transport infrastructure works so that the regulation happens at the point of price. So toll on a toll road grows with inflation. The charge that you pay at an airport grows with inflation. So what you get as an owner of a transport infrastructure assets is you get your revenues growing at volume plus inflation. You've got a relatively fixed cost line, so you should over time see that your returns, your earnings growing over time. So again, now the first chart that we show you here looks at EBITDA, at earnings for toll roads over the last 5 years, and what you see is that slowly growing trend over that period. In 2008, 2009 you see a lower rate of growth, more stability, but you certainly don't see a significant downturn as was experienced in the broader economy. You get the sense of that very reliable earnings stream over time. Similarly, the second chart shows the earnings defined as EBITDA coming out of the airports that sit in the Magellan infrastructure portfolio over the last 5 years. And again, you see that same picture, very slow rate of growth, growing those earnings over time, with something of a hiatus in 2008, 2009, but certainly not a downturn. Earnings growing progressively over time, and that's very much what we would expect to see.
Gerald, do you have any stock-specific examples that you'd like to comment on?
Yeah, there's probably 4 examples that I've chosen. Each of these 4 companies, each of these 4 examples is a part of our top 10 stocks, our 10 largest holdings. I've chosen a water utility, an energy utility, a toll road and an airport. They're all representative, I would say, of the different segments. The water utility is American Waterworks. In the last year it grew earnings at 13%. It's grown earnings at 14% over the last 3 years on average. And it's got a long-term earnings expectation of 7 to 10% growth in its EPS. It's the largest water utility, listed water utility in the US. And you know, a phenomenally good story, exactly what we seek, a very reliable earnings stream with the opportunity to grow earnings over time. So, you know, classic example of what we seek to invest in. Second example is Wisconsin Energy. Wisconsin Energy provides electricity and gas utility service in the state of Wisconsin and also in the state of Michigan in the USA. Wisconsin Energy grew earnings last year at 19% and at 12% over the last 3 years. So again, very reliable earnings, notwithstanding a lot of volatility, difficult economic conditions in the US, very reliable earnings with some robust growth over the period. The third example is Transurban. Transurban, as many of our investors will know, owns a portfolio of urban toll roads in Australia and also the US. In last year, for the year ended 30 June 2011, it grew revenue at 10%, EBITDA at 13%, and distributions at 12.5%. You know, very robust results, very impressive results. Similarly, over a 3-year period, grew earnings measured as EBITDA at 10% per annum. You know, incredibly robust, incredibly reliable results, exactly what we seek. And the final example is Zurich Airport. Zurich Airport, not surprisingly, owns and operates the airport in Zurich in Switzerland. Last year grew passengers at 4%, has grown passengers over the last 3 years at about 3% per annum. So low but stable growth in underlying volumes. However, that translated into an earnings growth last year of 23.6% and over the 3 years of 14%. Again, you know, remarkably robust results in what have been difficult and challenging economic conditions.
Thanks, Gerald.
Thanks, Frank.
And thank you for watching. And if you'd like to know more about Magellan's infrastructure capability, feel free to visit our website or contact our distribution team.